Hi, my name is Paul, and welcome to my monthly portfolio review series, where so far I've invested $100 per month into Canadian securities for 27 months straight. And I've done so with the intention of emulating the journey of a hypothetical Canadian who will never be able to max out their tax-free savings account. But despite these circumstances, I think that by following a disciplined plan of investing $100 every month, our Canadian protagonist will be able to achieve retirement and live happily off of their investments in financial freedom. And this episode is going to be a quicker one since there really wasn't any major news to come out over the past month pertaining to the portfolio's holdings. The only thing to mention was that the Morguard North American Residential REIT will be releasing its earnings results on April 30th and holding their conference call on Thursday, May the 2nd. And I think I'll probably make a separate video to cover the earnings report, since I won't have time to cover that in May's video if I want it to come out on time. Aside from that, nothing to cover. So transitioning into the performance of the individual holdings, from when I purchased shares last month, the Morguard North American Residential REIT shares dropped from $15.97 to $15.56, or about 2.57% if we don't include the monthly dividend that was paid. And unfortunately, the REIT was the portfolio's best performer for the month of March. The second largest holding, MTY Food Group, dipped from $50.60 to $48.71, or about 3.74%. Meanwhile, the smallest position was the worst performer. That, of course, being GoEasy, which dropped 4.46% from where it started the month at $166.49, leaving it at $159.06. But I didn't buy any shares of GoEasy last month, so the upside is that my 1 month performance isn't going to look as bad as it could have. And yeah, you know that it's bad when that's the best angle that I could have taken when presenting this. Anyway, all the figures here were based off of prices as of the market's close on Thursday, April the 4th. Unfortunately, with all three of the portfolio's positions yielding a negative 1 month result, the portfolio as a whole moved a bit further into the red than it was last time, as I'm now down roughly $116 or 4.15% on the $2,798 that I've invested into the account, which does include the reinvested dividends. But even without those reinvested dividends, I would still be down about $18 on the $2,700 that I've personally put into the account. Comparing my 1 month performance to the ETF benchmarks, I've once again taken a small step in the wrong direction and my portfolio had the worst performance. As for the second worst performer in the month of March, that was the S&P 500, which barely eked out a gain, achieving a 0.16% increase if we don't include the quarterly dividend that was paid out. Next was the Canadian Large Cap ETF with a gain of 1.58%, which followed behind the Canadian All Cap ETF with an increase of 2.19%, leaving March's best performance title to the Global Value ETF, which turned out a 4.38% upwards move. But that is, of course, just the performance of last month's invested capital. This chart here shows us the total all-time gain net of contributed capital for all of the tracked ETFs as well as my own portfolio marked in green. And yeah, we've kind of just been hovering around the break-even mark for the past few months. And short of some exceptional news coming out, I don't really expect things to change for a while since we don't really have any major earnings or news expected to come out until May. But that's not necessarily a bad thing since it's going to give me a chance to continue building up my positions in what I believe are undervalued equities. So I probably won't be catching any of the benchmarks next month. However, there's still some drama to be had as there is a battle brewing for first place between the Global Value ETF and the S&P 500, both of which are getting very close to surpassing $700 in gains. Centering our focus back in on my portfolio, I'm once again a bit further away from catching the red goal line with the stars, which represents a 12% annualized rate of return. And right now, the portfolio would need to increase by 14.2% just to get back on track with my goal. But again, this is a marathon, not a sprint, and as I've already said many times, I don't mind being behind for even a few years if that means building up positions that will eventually lead to outperformance and success. And so long as I continue to invest in quality companies that I understand well and that have strong underlying fundamentals, I believe I'll be able to take back that first place spot. especially if we see some sort of correction in valuations. Currently, the benchmarked Vanguard S&P 500 Index ETF has a price-to-earnings ratio of about 26.5, which is nearly 38% higher than its historical average of about 19.2. So if we expect that there will be a reversion to the mean, we should either expect the share price of the index to come down by between 27 to 28%, or business earnings to increase by the previously mentioned 38%. Realistically, if a reversion is to happen, we'll probably see a little bit of both, with share prices coming down somewhere around 13 to 14% and earnings increasing somewhere by around 19%. Personally, I'd hazard a guess that there's more optimism baked into the earnings increasing and that we should probably expect a greater decrease in prices, but that's sheer speculation, and I'm by no means a macroeconomist. Not that you should listen to my macroeconomics take, even if I was one. And that's not me taking a cheap shot at economists. You just need to know that even professionals who study economics don't have a great track record of predicting if and when a correction will happen. They're just incredibly hard to predict. So you should definitely take what I, an untrained layman, am saying with a healthy dose of skepticism. Noting that, my portfolio's average price-to-earnings ratio is between 11.2 and 11.3. Meaning that my holdings are trading significantly below the average earnings multiple of the broader market's historically typical levels, let alone the current multiples. This means that if my portfolio's average PE ratio simply reverts to the mean levels of 19.2, then I could see my portfolio rise by as much as 70%. Though again, this is the high end of expectations and it doesn't take into account the potential for business earnings to decrease, or any other important variable for that matter, because this comparison is highly generalized and I'm only doing it to showcase the possible upside and downside scenarios that can be generated by solely zoning in on one metric. If investing were just as easy as simply buying companies with low multiples and selling the ones that are trading at higher multiples, then there would be no need to distinguish between individual companies. Instead, we'd only compare metrics, which is not something that the aspiring investor should be doing. And while doing this does illustrate something that I believe to be true, that being that my holdings are undervalued, especially relative to the broader market, I don't like to do this sort of analysis because it's overly reductive. It doesn't tell you anything about the competitive landscape, growth vectors, future challenges, management, or any of the other factors that are important when looking at prospective investments. It won't showcase that MRG shares are trading at 1/3 of NAV. It won't point out that MTY's franchising business is incredibly capital light and free cash flow heavy. And it won't point out any of the risks involved in GoEasy's business of lending out money to people with poor credit scores. Without understanding the underlying business, you can't know if a stock is undervalued and poised to rise, or if the opposite is true, regardless of any individual metric. But having put in the work to understand what I'm invested in, I am still quite confident that my holdings are all trading at cheap prices and are poised to increase in due time. And having also compared these securities to other stocks in the market, I've come away with buttressed convictions, which I've highlighted in past videos. This is why I will continue to be buying shares of the Morguard North American Residential REIT, MTY Food Group, and probably GoEasy, which is even cheaper than last month and now just below my target buy price of $160. All right, I'm back inside the Wealthsimple account and it is Friday, April the 5th, and it looks like GoEasy has crossed slightly above where I was willing to buy it at that $160 mark. So I'm not going to be buying any of that, especially since we're looking at MTY prices below 49 and Morguard's come up a little bit, but it's still quite cheap. So we're probably going to do the exact same as last month, buying 4 shares of Morguard. Oh, it looks like they have changed it a bit. And I'm going to have to figure out how to do this. Did I just click this trade button? Yep. Okay. Easy enough. Okay, there's our 4 shares of Morguard. And that leaves us $44.22. And for some reason, it's a little bit delayed here. So I guess they just added one extra button to click. Not sure why they did that, but they did. And it's on fractional buy, so we'll do our $44.22 that's remaining, and we will buy that in MTY shares. All right, and let's see if that still takes until 3 o'clock to fill. Yeah, it is still pending, so I will come back once I get the email verification that the shares have been purchased. Okay, I've just received the email confirming that I've successfully purchased 4 shares of the Morguard North American Residential REIT for $15.75 each, and 0.9035 shares of MTY Food Group at a cost basis of $48.94 per whole share, leaving my portfolio with no cash left over after my orders were filled. So, as of the market's close on Friday, April the 5th, the portfolio has 125 shares of the Morguard North American Residential REIT worth roughly $1,964, about 11.9 shares of MTY Food Group worth nearly $579, and the same 1.62 shares of GoEasy, which are now worth about $262. Taking a look at the dividend tracking chart, in March the portfolio earned a total of $7.22, all of which came from Morguard's monthly distribution. And with that, we've reached 1/4 of 2024's dividends paid out, putting us at just over 19% of the $130 goal for 2024. So I'm a bit behind right now, but I still think that I'm on track to hit the goal, because as I continue to invest throughout the year, I should be able to accumulate more and more shares that pay out more and more in monthly dividends, which is in line with the trend that we've seen so far throughout the series. So what can we buy with the $7.22 earned last month? Well, that's enough to buy these 2 bottles of shaving cream, which are on sale, and should keep us looking trim and proper enough to land a job that'll provide us the rest of the income that we'll need to survive the remainder of the month. But one day, that dream of financial freedom will be achieved. Until then, we're just going to have to continue on 1 month at a time. And next month, we're projected to receive $9.36 coming from both the Morguard North American Residential REIT and GoEasy. Taking a look at the yield on cost, as of this moment, if I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no additional dividend hikes or share purchases, I can now expect to receive $113.38, which is another 3.63% increase from what was expected last month. And this puts the yield on contributed capital for the total portfolio at 4.05%. And that concludes the episode. So, thanks for watching, but before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thanks for watching all the way to the end, and enjoy the rest of your day.